Now these are some of the Oracle asset setup steps. Okay, the ones on the left, these are required. The ones in the middle, some default values will be necessary, and the ones on the right in blue are the optional ones. So the required ones being defining of ledger. Obviously, if you're implementing along with financials, it is taken care of. The other flex fields like asset key flex field, asset category, these are the three main key flex fields that you have in assets. Asset key flex field, asset category key flex field, and location key flex field. So after you define these three key flex fields, you will be defining, you will be setting the options for the system controls. You will also define the fiscal years. What is your fiscal year? The okay, taxation year, the calendars for depreciation or for tracking other information. Um, the book controls, how are your asset books to be used, numbering, and which business units are assigned, and so on and so forth. What are the prorate and the retirement conventions? And finally, what are the different asset categories that you need to be defining using the asset category key flex field? And obviously these are the other required things. The important ones here is the depreciation method. There are various depreciation methods. If you go on the net, you will find more explanation about the different depreciation methods, but things like straight line or prorated and things like that are different depreciation method. Simplest one is obviously a percentage or straight line kind of thing, 20% every year or 33.3% every year, and so on. Okay, so those are your depreciation methods. Optional steps include unit of measure classes, units of measure, employees, descriptive flex fields, numbering, suppliers, location combinations, asset keys combinations, security, investment tax credits, price indexes, distribution sets, leases, warranties, profile options, and insurance. So typically these are your optional steps that you have. As you can make out from most of them, you can make out from your the names itself what kind of information they hold. These are the three important key flex fields that you need to have. The asset category, it defines the category of the assets. As you know, in an organization there can be different types of assets. Then you have the asset location key flex field, which identifies the exact location of your asset, where it is and how it is to be used, and it tags whether it is, your assets could be located at different places, factories or sites or project sites, and different factories locations. So that is what it tracks. And you have the asset key flex field, which is the identifier for your asset. That is every asset has to be numbered. So these could be a way of identifying a unique asset within the organization. So these are the different steps that you have for for implementing your assets, planning the implementation, setting up the asset management system, configuring the I assets also if required, converting existing asset information, and reconciling with the previous system. Means the legacy system from where you have migrated the assets into Fusion. Typically, when we talk about assets, the most important thing here is the asset book. Asset book is the uh, list of all the assets that exist within any organization. Okay, so these assets are the asset book contains the list of assets that exist in the organization along with their, what depreciation methods are to be used and depreciations that are charged. Anything relating to the assets is in the assets. So when we define assets, when new assets are acquired, we assign the assets to the asset book. Okay, and we assign the assets a category. The categories in turn are linked to the depreciation methods and the asset books. So based on that, the assets get assigned. The calendars, on the other hand, are assigned to asset books. And typically, asset books are of three types: corporate, tax, and budget. Asset categories are defined upfront, and we link the asset categories to the asset books are attached to the asset categories, so that whenever you are assigning the assets to the asset categories, they in turn get linked to your asset books. Okay, you don't directly assign the assets to your asset books. Instead, you assign the assets to the asset categories, and the asset categories you assign to the corporate books or the tax book or tax ABC, the different asset books. The typical life cycle of an asset is described here. It starts with so-called birth of an asset, that is when you are creating a new addition, manual addition or a quick addition, you add new assets. Okay, so the assets are put into the asset books. Over a period of time, asset will depreciate and eventually you will retire the asset or you will sell off the asset. Okay, so all these are added to the asset. Now you can add the assets manually, okay, through quick additions, or you can add quick additions is basically minimum asset information which you can quickly upload into the system through the excels. Detail additions on the other hand are all the individual fields are filled up. Obviously you don't have all the information upfront. Adding mass additions, any mass additions are typically your, you can say, like an interface to load assets from other applications. So things like from other parts like payables, projects, or any other system, we load it through the mass addition into assets. So when we have a CIP type of asset, construction in progress asset, typically that is used when we want to put that into, capitalize it and put it into the balance sheet. And you can keep, as you invest into a project over a period of 1 year, 2 year, 3 years, you can keep adding things into your balance sheet. So over a period of time, you will see items getting added gradually, the value of the asset getting added value gradually, which Suppose you have a 100 crore asset that you are adding. Every year over a period of 5 years, you may be adding 20 crores as you are investing in your project. So gradually your 100 crore will come up, but every year you could be doing part of it. So you could be capitalizing a part of your asset instead of the entire asset at one go. So you can do the manual additions, or you can use from your projects, you can use the mass additions to add up your CIP assets. Even through payables, when you are investing in your asset, you can add the value to your asset. Any asset adjustments that you may have, you may need to reclassify your assets, or you there might be some items that get broken, so you might need to repair them, or you might need to uh, add some, or some parts of it might get you originally you had 5 units, one of the units gets bad or it crashes and it's no longer usable, only 4 units are usable. So those kind of unit changes also you can do through the asset adjustments. So these are typically things that asset adjustment allows through, as you can do through mass additions. Mostly yes, except you cannot change the number of units through mass additions. Most of the reclassification of financial information changes, cost, depreciation information, all those you can update. And you have the transfer also. You can change the asset assignment information. One of the important aspects of assets is doing a physical inventory check. Large companies, particularly manufacturing companies, they have lots and lots of assets which are like raw materials, or which are parts, machine parts, or individual components of the machines which are used to generate your which are used to generate your assets. So in that case, you may have to, you are issuing those items, or you are sometimes purchasing assets, but you don't use those parts, or you don't use those expense items. You release them from inventory, but you don't send it back to inventory. So those additions, subtractions are not always in sync. So what happens? The actual value of your inventory is different from the inventory as per your system. So you need to do a physical check as to what is there in your inventory and what is missing from your inventory. Okay, so the reconciliation between physical and online reconciliation is important. So in terms of depreciation, these are the typical elements or aspects of depreciation that one needs to keep in mind. Starting from depreciation